In this video, let's talk about how do we calculate a gain or loss, and then we'll also dive deeper into how do we calculate the amount realized, adjusted basis, to determine our final gain or loss. All right, so when it comes to short-term or long-term capital gains and losses, we have to run through the following formula here. So if we look here, we see that we have an amount realized minus the adjusted basis equals our gain or loss realized. So what does that mean? All right, so first and foremost, the amount realized. All right, amount realized is going to be simply this. The amount realized will be the amount realized from a sale or other disposition, all right, that is equal to the sum of the money received plus the fair market value of any other property received. And then we subtract out the cost to transfer that property. Now, if the taxpayer is relieved of a liability, that liability amount is added to the amount realized. All right, so what are we talking about here? All right, so amount realized is going to be things such as the sum of the money received. So sum of money received, I before E, except after. See. All right, I always have to do that, so you get that. Sum of money received, fair market value of any property received, so we'll say FMV for short, of property received. And I'm just abbreviating for received there. Less the cost paid to transfer the property, so we subtract out transfer cost. All right, these are going to be things like let's say, i.e., real estate commissions if we're selling a home. All right, things like that, selling fees. And then if we have the situation where a liability is assumed, so let's say we sell a car for $10,000 and it has a $2,000 balance left on the car note, and the buyer assumes that $2,000, that assumed liability, so we'll say assumed liability is added to the amount realized. All right, so you sell a car for $10,000, the buyer assumes a $2,000 note on that car, then you really got the amount realized of $12,000 in that example. Now I'll run through a more comprehensive example here, but I want to run down what the basics of these two items are here. All right, so then we get over to the concept of adjusted basis. All right, so I think we understand what amount realized is at this point, but let's jump back on that in our comprehensive example. The adjusted basis of a property, that's going to be the original basis, which is typically the amount that you paid for a property. We add in any capital improvements and then subtract out accumulated depreciation. All right, so let's go ahead and write this out. So this is going to be original basis plus any capital improvements. All right, it's going to be in the sake of a home, things like, you put a new roof on, you added a patio, maybe put a new deck on the house, and then we subtract out any accumulated depreciation. All right, so in the case of a rental property, this is a little easier to wrap your head around accumulated depreciation, because as you rent that property out, as you use that property in your basically your business endeavors, you've accumulated depreciation on that property, and as such, that depreciation comes out of your basis. So that simply is the overarching definitions of these two concepts here. So you have amount realized and adjusted basis. So let's walk through a quick example so we can gain an understanding of what an amount realized is. In this example, Sydney Jean sells some real estate that she held in as investment for $100,000 cash. All right. She had $50,000 left on the mortgage, and the buyer assumed that. So let me get my red pen out so I can start underlining things that are important. Sold it for $100,000. She was relieved of a $50,000 mortgage, and she paid $12,000 in real estate commissions and other transfer costs. So the question is, how much did Sid realize in this problem? And on this particular case, Sid realizes this. So the first line item is going to be cash received All right, so she received cash of $100,000. The next item is going to be any liabilities that were transferred. So liability transferred. And remember, she did transfer over that $50,000. So that's that. So that would mean that her total sale price, all right? So total sale price is going to be $150,000. All right, but we're not done. We're not done. She also had $12,000 in transfer cost, real estate commissions, things that usually accompany a real estate transaction. All right, so then we have to subtract that out. So we're going to say less. We'll call these selling costs. Let's call them selling costs. You can call them transfer cost. I like using the term selling cost. That is insignificant. In this case, remember from up top here, we have the 12,000 that is noted here. You simply subtract out. I like to use parentheses for my subtractions. All right, so then we have 150 minus that 12,000. So you're looking at a total amount realized. So let me scroll down just a touch here so we can make this a little neat. All right. Total amount realized. It's going to be the 150 minus that 12. So it's going to be 150 minus 10 minus 2. So that's going to be 140, 138. Total amount realized is going to be 138,000. All right, so we go back up here to our original formula. Sydney received 138,000. That is what she realized. Now for the adjusted basis for this problem, we're going to make this up as we go. All right, so we're going to come up with a reasonable amount for this. So we're going to say that Sydney, when she bought this house, we'll say she bought it 10 years ago. All right, she bought the house 10 years ago for $30,000. I know that that's unreasonable, but we're trying to make math easy, all right, because you don't want to torture your accounting professor's brain with hard math. I know that sounds counterintuitive, but it's been a long day. All right, so that's the original basis here. That's what Sid purchases for. We'll call that original basis. Over the years, she really liked the place. She liked the tenants. She added a deck. She added a patio. She added a fence, etc. And in combination, all of those things equaled $20,000. $20,000 for all that work. That's a great price in these expensive times. I don't know if anybody's tried to get any homework done right now, but it's expensive. All right, so we'll just say that's our capital improvements. All right. So far, she's at $50,000 of basis. But now she depreciated this, and we're going to make life super easy on ourselves. We're going to say that she depreciated it at $1,000 per year. All right. That is not ever going to be that simple in real life, but for the sake of this problem, we're going to say that this was our depreciation for this problem because we like easy math. All right, so remember, 10 years ago she bought this property, $1,000 per year. We can say that there's $10,000 of depreciation, which means we subtract it out. So the adjusted basis for her property is going to be the original basis of 30 plus the capital improvement of the deck, the patio, all of that stuff of 20, bringing it to 50. And then we back out the accumulated depreciation. So we'll call this ACC DEPR, short for accumulated depreciation, for an adjusted basis, total adjusted basis of $40,000. So that is how you calculate your adjusted basis. So then you take this here, adjusted basis, remember from right over here, 40,000. Subtract that 40,000, and what you end up with is a gain of, so this is a gain of, in this case, it's going to be 138 minus 38 plus 2, so we're going to go $98,000. All right, and just as a quick little recap on long-term versus short-term holdings, because this property was held for well over 1 year and 1 day, this is going to be a long-term capital gain. So we'll call this long-term capital gain. And you just learned how to calculate a gain or loss based on the amount realized, the adjusted basis, to determine that final gain or loss figure.